Mr. Hanna, you're able to do drugs during the day and still function, still do your job?
Well, how the fuck else would you do this job? Cocaine and hookers, my friend.
It's weekend time once again, and as you may tell by my voice, it's that time of the year. I'm a little bit under the weather. Look, if you noticed by checking the clock here, I'm recording the intro basically as the last part of the video because, first of all, I wasn't sure on how to proceed because I'm really lacking a lot of voice here, and I wasn't sure about what I wanted to discuss. So, obviously, it was a very interesting week with all the things which went on in Venezuela, but I'm telling you right away, I'm not going to discuss that. Not at all. Maybe a brief hint while talking about oil, but other than that, nothing more. And, after this introduction is ended, if you don't care about all the macro stuff and all the data points which came out this week, you just skip ahead 26 minutes from the beginning of the next section if you want to go directly to the charts, all right? There's the usual good enough parentheses about metals if you're interested. And of course, other good reasons for why we might see more volatility getting into metals. And of course, the usual part about the stock market. And, a little bit of outlook, AKA, expectations for the years to come. Well, for the year to come, just, next year or this year, right? But, I just want to give out the warning because it might look, while you skip from one section to the next, that there is really not some sort of a continuity in between one and the other. But that's just because, as I said, I wasn't sure of, how long could I keep up the talks, considering that my voice is particularly lackluster. It was a very interesting week. I mean, also here, right? Like on Tuesday, I went to bed on a Monday, and the weather forecast, it was talking about sun the next day. I woke up on a Tuesday morning and it was fucking snowing, which for us here where I do live, kind of the center of Italy, is like 30 kilometers out of Florence, which should be kind of like 19, 20 miles out of Florence, right? Or it's slap in the center. And it never snows where I do live. I woke up to that. So, very, very strange week. But of course, the sudden drop in temperatures got me once again. And this is why my voice is fucked up, as you can tell. So without further ado, let's just jump straight in. And the disclaimer is out. Enjoy. Let's have a look at the economic calendar and the news flow that we had throughout the week on, the different data points. We started out with ISM PMI for the manufacturing sector, which came in contraction territory. So 47.9, which, marks the third monthly decline in the index. So again, it's not pretty good for the manufacturing sector, no matter the claims of, bringing manufacturing back on land and all the rest. At this point, we are 1 year in or more, and we didn't see that yet. So I guess the point so it was a failure. The policy just failed. I don't know. It might be that it's going to work out in the coming future, but I'm just acknowledging the fact that for now it didn't. And I'm not picking sides, like politically. I'm not saying that Trump was stupid, or, you are stupid because you don't think he's going to pull it out. I'm just saying for now, it's not reflected in the data. So do what you wish with the data, but you can't argue with them unless, we are getting back to the talks about, are the data correct? Are the data lagging and all that? But, the market will move on the data and it will be worried about whether they are correct or not later on. So especially if you trade in the very short term, you might want to pay attention to the data as it is because the market will initially react to it, right? And that goes for everything like CPI, whatever you can think of, right? Although, as many other things, when you dig in, you may found that things are not always like they look on a surface level. And who knows? Maybe it is even for this one, right? We'll see. Now, moving on, we got, of course, the ISM Services PMI, which again came in positive enough. And if you look at the recent trend, it looks like it is recovering a little bit. Oh, actually, it is maintaining itself in an expansion territory because, it's the fusion index. So whenever it is about 50, it's marking expansion. We could argue about what level of expansion would you need to sustain in order to generate a good enough economic growth. But, at the end of the day, if you compare this one with the manufacturing sector, it's clear that this one is actually performing better. And again, overall, for the entirety of the domestic economy, this is kind of what really matters, because we have discussed many, many times in the past, the US economy, it's 68, 70% consumption. So services, they play a bigger role. It's a much more services-oriented economy rather than a production, manufacturing economy. So, it might be the reason why, although you see all the things you see, like the K-shaped economy or different districts, different states being in different shape economically, but at the end of the day, overall, if you look at the aggregate for the entire nation, GDP, it's still, still positive. And, although it might contract in the future or not be as bright as it is or as it has been for 2023, 24, still positive territory, right? And this is a major contributor to that. Let's move on. We got ADP, which here we start to talk about some things which are a bit worse in my view. But I mean, it's no mystery that the labor market, it's softening, right? Every single week or every single month. Once again, it's not crashing. It is just softening. So deterioration, yeah, but as many other things, it's always important to look at the pace at which something it is deteriorating or going down or slowing down, right? So the ADP actually increased, right, by 41K jobs in December. But, if you zoom in a little bit, you see that over the previous months, more often than not, it was showing a loss of jobs. So at the end of the day, sure, again, it's not a sinking boat, but it's not your strong and resilient economy running on all of the proverbial 8 cylinders, so to speak. I think that, right now, if you want to dig in a bit more, we could look at that. So, actually, this is for the JOLTS. But anyway, it's still kind of like, we're going to get to it in a minute, so still kind of related. But look at that. Just to confirm that the labor market is softening, you see in purple, these are the job openings, right? They're trending down since basically 2022. Same for the hires, right? So how many people are hired for a new job every single month, just trending down. Of course, layoffs and discharges, they are not spiking to the upside, which again, to me, it just reflects one more time the fact that the labor market, it is stalling, right? But it's not really collapsing. Sure, you can't be happy about this one, right? If you look above, but at the same time, it's like you shouldn't be desperate about this one spiking to the upside. It's not like we are not hiring and we are firing. We are not hiring, but so far we didn't see a massive tidal wave of layoffs. A lot of them were announced and planned, but I mean, I guess up until the point they don't materialize themselves and they can impact the actual purchasing power of people or the sentiment or the economic behavior, I think we shouldn't really call for the Armageddon, rather, economically or financially. It's not good. I'm not going to stay here and pretend that everything is rosy, but at the same time, it's not a disaster so far. We'll see in the future. I'm not very optimistic about the labor market in the US for now, as for anywhere else in the world, for what matters. And now, since that we spoiled that a little bit, here are the job openings, which again, they fell a little bit, as you can see. And even these ones, over the last 2 months, they just came down. What else? We've been talked a lot in the past about these job openings or, jobs opportunities being posted and, being kept posted. There is a lot to it, especially if you want to give the impression that you're actually looking for new employees so that you project your company as very healthy. We are actually looking for new employees. But, if you then look at how many people are actually hired, well, not a lot. So what's that? Is that you never find the right person for the job, or maybe you just keep those announcements posted, but then you don't really intend to hire anyone, right? So it's just a for show or some sort of a window dressing. The data tells us that, this data point right here was particularly bad starting from 2022. It kept on coming down since the middle of 2024, and it never recovered ever since. So again, stalling, deteriorating, whatever you want to call it. Moving on, we got the initial claims. And look, there was a period where they were spiking up. But again, if you look at it in the entirety of the context we are running through, if they are coming down, that would suggest that, again, there are not enough new people to actually apply for this type of measurement that the government has for those which are losing the job. So maybe, just maybe, that's a good thing, or at least that's something which can offset the lack of hiring, or the fact that the labor market is actually softening. Let's have a look at this one, which is a little bit more damning, which is the continuing jobless claims. So although you don't have new people applying for, what was the term? Unemployment protection, something like it. Those which did in the past, it doesn't seem that they can come off of it very easily. Now, sure, the data point ticked down a tiny bit, considering that, if you look at it from October, September, it ticked down. Might also be seasonality. We are just coming off the festivity period, so a lot of temporary hiring maybe. So, this is the data in its entirety, but even in this one, I'm sure if you dig in a bit more, which we don't have enough time here, but you would find that it's not as rosy as you might think by just judging it at face value, right? 4 weeks average, slowing down again. Why not? If the headline it's coming down, the average should be reflected in it, right? So usual small talk about unemployment claims, which for me are not really one of the most important things when it comes down to macroeconomic data as a whole, or even the labor market as a specific topic. But they are released, so we go through them. Now, we got the big start of the week, NFP, which came out on a Friday. It came out at, 50K, which I think was a miss because it was expected at what? Well, at 60. So, 10K miss. Previous one was 56. I think the previous one was revised, if I'm not mistaken. Yeah, it was downwardly revised. So again, labor market, not cool. But, this is nothing new. We have been looking at the amount of revisions. It looks like, at least for 2025, I don't remember 2024, but 2025, every single one of the NFP releases was revised after the fact. And I think the vast majority of it, I think 90% maybe, it was revised to the downside. So what does it tell you about, the health of the labor market? Not a lot of good things. You want to dig it out. What you could see is this one, basically. So, okay, so October was revised down by 68,000, right? So, if you thought October was bad at minus 105, what about 173,000 down? November was revised down by 8,000, so from plus 64 down to plus 56. So, if you combine these 2 months, the initial figures, they just overestimated the reality, let's call it, by 76,000. So I mean, not so cool, right? And again, the report is actually particularly detailed in my view, because then if you go over it, it just tells you a lot of things that the rough number is actually not telling you. Like, for instance, look at the long-term unemployed, because, they released the NFP, they released the unemployment data, which, spoiler, again, it ticked down to 4.4, right? But although, it looks like unemployment came down a tad, so that must be good. Yeah, well, again, up until the point you look under the hood, and what you see is that the problem is that a lot of people which were unemployed, they kept on being unemployed, right? They usually talk about 27 weeks or more, right? So, at the end of the day, if you can just read this paragraph, you see that the situation is not that bad. And again, as we have looked at in the past, the problem is also in between full employment, full-time employment, and part-time employment, for economic reasons, of course. So all those people which are working part-time, not because they so choose, but because they are forced to it. Or maybe their hours were cut because there is not a lot of demand. The backlogs are completely empty at this point. So, they just cut their hours. So at the end of the day, a very long way of saying that the labor market is not really in the best shape of all time, but I think that's no mystery, right? And here you have it, the unemployment rate. This should be the U3, 4.4. I think, it ticked down by what? 10 basis points? What about the participation rate? It came down as well. But from what? 62.5 in November, 62.4 in December. But, as you can see, it's going down for months now. Why it is important? Well, obviously, because the way that unemployment is calculated, right? Or at least, the headline figure. And again, this is another thing we have been discussing in the past, but, I'm not going to reiterate the entire thing. Just think about how they calculate the headline unemployment and which people they count in, right? And then think about the difference in between the U3 and the U6 and see why maybe one of the two is a better measure of real unemployment than the other, when you start to consider that people which are not, finding or applying for a job or looking for a job for more than 3, 4, 5, 10 weeks, you can exclude them from the official unemployment rate, but there are still people without a job. So, you can depict a situation which looks better than what it really is if you start to play with the numbers, but it doesn't change reality for the average Joe and people in the real economy and in real life, right? Testimony that hours have been not only cut, but even the earnings on a hour-by-hour base, it was down. So again, the consumer, it's really facing a tough situation in here. Not to say, because we've seen the data, and we're going to have retail sales next week, I guess, but think about the consumer as a very, very creative type of creature. I don't have any money. Well, let's see, how can I find more money? Oh, look, buy now, pay later, right? Or, well, I can draw down my line of credit, or I can max out my credit card, right? So there are many ways by which the consumer can actually tap into more financial resources. And it can go ahead for, quite a bit of time before he finally gives up. And he doesn't have any other form of, it could be financing, it could be savings, it could be whatever means that allows him to keep on spending, right? So that would be it. Weekly hours, of course, over the last 5 years, you can judge it for itself. Just going down, and then it's been stagnant over the last 12 months, 18 months, something like it. So again, no good news for the labor market. And, that's at a point that's going to be reflected in other sectors of the economy and most likely, the financial markets. Unless, of course, there is another type of intervention by the government. And, that is not only it is always possible, but that's the playbook. So again, you might think that just because we look at the economy and the real economy, it's kind of starting to go down the drain, financial markets need to crash next month. Well, they're not particularly correlated. Over a long enough period of time, sure, of course, because, especially the stock market, what is that? A mechanism of future cash flow discounting? Yeah. Or, is it based on fundamentals like earnings, revenues, and all the rest? And where do revenues and earnings come from? Consumer spending. If the consumers cannot spend anymore because they don't have a job, sooner or later it's going to be reflected in the financial assets as well. But it takes time, right? So just keep things in perspective, right? And we ended up with the Michigan Consumer Sentiment report, which still on the floor at the end of the day, 53. I mean, if you zoom out 10 years, it's basically at the lows of the last 10 years. Do we have, no, we don't have a max here, but just to give it context, the consumer, right, for all we have been discussed so far, obviously is not very happy. And again, this might play a role. It might have different ramifications in a year like this where we got midterms, right? It wasn't me which coined the term, it's the economy stupid. At the end of the day, yeah, political bias, ideology, philosophy, personal preferences, whatever, different words of view. But at the end of the day, people vote with a wallet. And, they tend to cast a vote based on the fact they feel richer or they feel poorer, right? So it's going to be something which is going to come back in full force, and it should not be discounted, right? Over a long enough period of time, again. As for the break-evens, what we see, they ticked up a little bit this week, but again, the trend, it's still down, which is again confirmed in the Trueflation PCE, which came up a bit, right? But still, 2%. Last week was what? 1.8, 1.7, something like it. So not a huge variation, but yeah, there it is. Same for CPI, which was at 1.71, maybe last week. 1.88% this week. So, by judging, by looking at the chart, you can judge that it didn't move a lot and it's still trending down at the end of the day. Or, at least if you don't want to say trending down, look at it in the context of the year, right? We're still here. Now we started out massively higher and then we came massively lower. We kept on drifting higher and we ended up getting back lower toward the mean. So, inflation is not a huge problem, at least for now, right? So GDP now was updated. It got up to, I think it was 5.4 throughout the week. And then yesterday, I think they brought it back down to 5.1. I think a lot of it, if we get back to the first, to the main page of the calendar, a lot of it was the exports and the imports. If we can quickly look at them. Now, look at that. So exports went up massively, right? It's not that they went up just this month. And bear in mind, we got the data which are particularly delayed. We are looking at October, but again, it is what it is. And imports, they went down. They started to go down in March 2025. So if you combine these two, what's going to happen? Well, if you export more and if you import less, the trade deficit is going to be narrow. So, overall, if you think about the GDP formula, that should be good. That should be boosting the final result as for GDP, if I'm not mistaken with the math or the formula. But, again, it's nothing new. If you look at exports, for instance, and I think especially what's going on geopolitically, what we've seen is that, for instance, exports of gold, they just skyrocketed. Now you might say, well, sure, but it might just be people which were actually storing their gold in the US, trying to bring it back home. Well, I mean, whatever the reason is, but there was a lot of gold exports, right? Other than that, still thinking about geopolitics, what you could have. Look, this one right here, LNG exports. They massively went up, right? Over the last, 5 years, basically. So at the end of the day, if you sum all together, this is not updated, but it gives you the perception of what's going on, updated to September. You see that the trade deficit, it's just shrinking itself. With many different ramifications, of course, because an hour trade deficit is actually good for the US as for the domestic economy, but it is bad for the rest of the world if you think about it, right? Because what does it mean? Well, if they export more, but they import less dollars are flowing out of the US into the rest of the world on net balance, right? And if you think that it is true, the US has a massive deficit problem, a massive debt burden, well, so do the rest of the world. The problem is the US can actually print the difference if they want. The rest of the world, which for one reason or another, I'm not here to judge, but decided to go on a US dollar standard and has a lot of US denominated debt, if they cannot acquire those dollars to roll over the debt or pay down the dollar liabilities, if they don't get those dollars from the trades, it's going to be a problem for them, right? So we'll see how it plays out, but that's enough for the economic calendar, I think. Unless you want to check the credit spreads, but nothing really changed in it. It's still very low. Same as the VIX. We rarely talk about the VIX, but the VIX is at 14.5, right? So very low. I think, another factor in favor of a relatively stable, especially stock market, but financial markets overall, or risk on assets, right? This is true. At a point, it can't go lower, so we'll need to go higher. Same for the VIX, but we talk about it when we get there. So in spite of all of it, and especially I think GDP being up, FedWatch tool, it's now telling you that, look, they are basically pricing in no cuts for the next FOMC meeting, which again, I think is a mistake, especially if you are the Fed, and if you don't want to fall behind the curve, or if you want to be proactive, I would keep on cutting. Up until the point I don't see a surprise in inflation or a very decisive reacceleration of the economy, I would keep on cutting, right? It's not because, again, I do think we should just have QE, infinity, and rates slashed down to zero. No, I just think in the process of normalization, you could cut another 25 basis points. I wouldn't see it as a bad thing. But again, we'll see what they do. We might have a surprise. Wouldn't be the first time. Or, we have another pause, which, it wouldn't be unusual as well. We've seen the Fed, throughout the cutting cycle, starting to cut, pausing, then cutting again, and pausing maybe. So, wouldn't be unusual. We'll see how it plays out. And after that, I would say let's close this chapter down because it was so fucking long. All right? Talking about some charts, let's start out by looking at the DXY. Now, the DXY actually kept on bouncing this week. It was nice to see that we initially had, a little bit of a breach of this high. It was immediately rejected, but, that was on Monday. But over the remaining part of the week, we kept on running higher. Now, sure, nothing really changed substantially. Technically, it is just, I think it played out really nice. Like we completed this swing, we came back to base and we bounced off of it. The first attempt to break a high was rejected, but, no follow through to the downside, and we immediately kept on rallying back to the latest, or to the following point of release right in here. And for now, we found resistance back there. Interestingly, it's not only a point of release, but it matches up with a previous swing low, which was, of course, broken, retested, down we goes. So, at that point, you might expect this one to be treated as a resistance on the first test when we come back into it. We will see. I guess at this point, scenarios might be two, right? If I can use my keyboard correctly. One could be we are rejected in here and we get back into here, we hold this level and we try again higher, right? Or we, just extend this one to the right. Or this is a complete failure. We fail the retest, we get back below here, and immediately we start drifting back toward the lows, right? I mean, if something happens and the DXY shows a hell of a lot of strength, we just break through and we'll see what happens next. Maybe we retest here and then we go. Maybe we just shoot higher. Who knows? Too many things. I mean, now we are really going ahead of the of what should be the normal flow of the conversation. So for now, let's say if we have a rejection in here and then we accumulate and go higher, or if it is a failure and we get back into the previous range, and then we'll see if we stay in this range for a while, if we test back toward the lows. I would think that maybe the initial rejection, like I'm not talking a massive rejection, but maybe a little bit of a pullback here could be also, not only expected, but maybe also healthy if you are bullish to the XY. Like we are trying to come up by building the structure to the upside instead of just shooting higher and then, of course, being prone to massive retracements. So we'll see about that. It's a story for next week. Anyway, the only, let's call it, quote unquote, nice thing to see is that these sort of swings, these models, they keep on playing out, right? So that would be good. Now, as for the others, we have seen, let's start out with the British pound, right? So we have seen the British pound actually and finally testing back up into this apex and being rejected. It looks like, this is not the first time we approach this bullish shelf right in here. It was tested before the run up. We got back into here with a very decisive move. Normally I would be skeptical that it could actually hold, but maybe another tiny bounce from here and then we'll see. As for the euro, it traded very technically. As you can see, we were rejected after this double push into this previous apex. And this week, right away on Monday, look at that. On Monday, we came back down. We tested back into this shelf, immediately bounced, but then the bounce was faded. And look, you might think this is just a weak, a shadow, but, we're talking about what? The bounce was basically, almost 800 pips, which is, it's not a tiny move for the euro in just one day or something like that. And then the bounce was faded. We got back into this point of release, which is kind of like specular to the dollar, right? Or to the DXY, should I say. So we'll see what's going to happen next. If you do believe the dollar will face a tiny bit of initial resistance here, you should expect a tiny bounce in the euro. But look, the problem is that at that point, right, this was support before. It acted as support initially and then was broken. We broke a swing low here. So, even if we think there is a bounce in here, you got immediately two levels which could provide resistance now for the bounce. So either in here or in here, right? But they could provide a bit of resistance. So we'll see how it plays out. As for the yen, again, kept on going down. Although, major scares, the BOJ, B knockish, GGB's yield spiking. Yeah, the yen is not picking it up. So, there must be something to it. Or, simply put, up until the point you don't see it, it's not there. So why worrying? Right? The Canadian dollar, it came back down a lot this week. It kept on basically drawing back the entire leg to the upside. I mean, it's not necessarily bad. At this point, you're basically getting back into an area which I think should provide a bit of expected support, right? Because it was, we originated this wing from here, then we retested it. It was resistance broken, and then, support broken, then resistance. Now we broke above. So, I know it's an interesting pivot, right? So, if it reacted a lot of times in the past, you might expect a tiny bounce from here, and then we'll see what's going on, right? I mean, it doesn't mean that just because it responds positively once, it's not going to be, traded through and then used as a retest from the other side, as you've seen in the past. It's just like a pivot. For some reason or another, these 1.40, 1.39 area, it's a pivot that the market is particularly liking recently. And I'm talking basically, since August 2025. So keep an eye out for it. The Swiss franc came down. It just mean reverted toward the middle of the range. As you can see, it was range high in here. Just came back down to the bulk of liquidity right in the middle. We'll see if we have another full-on mean reversion to the other side and we deviate the other side of the range. Totally possible, but usually what you want to bet when something is extended toward the high side or the low side of the range, it's just a mean reversion to the midpoint of the range. And after that, you can reassess and look what happens, right? Other currencies, no major changes in here, like, the yuan kept on rallying, same for the South African rand. The ruble kept on, staying relatively flat at this point, right? Although, did we have that? We actually had it. Because that was Tuesday. That was Monday. Wait a second. No, we already had it. All right. Yeah, it was last week. Okay. Yeah, we discussed its point of release. These lows, very specular, very equal, so being targeted. So this week, what we did, we bounced. Now we tried to came back down. Well, we stayed in a range essentially. So from this point to this point, that's your current dealing range. So up until the point we don't break one way or the other, I would expect a bit more of the same for the ruble. The Brazilian real was interesting, right? Do you remember we were talking about it, and this was expected resistance. So potentially you could have taken a short in here. It was an easy one, we said, because that was a clear point of invalidation. If it breaks above the high, there's an open leg above it. So there is another opportunity to be long, right? Case in point, we broke it, came back to retest it, and we immediately tagged the initial resistance of the other side of the open leg. You could define it as, I guess it would be much more evident if you zoom in, but it looks like an overlapping gap, right? So you got a gap which originated when price leaves this entire area and breaks this swing low. That's the first part of the gap, or the external gap. And then you have another internal gap, which is basically this section from the highs back to when we break, or we get back to the lows of the consolidation. So if you can picture it, right? This is the external gap. This should be the internal gap. Usually, it's much more likely to bet and being successful with the feel of the external gap. Look, the internal gap could be filled, but not at first pass usually. So it might take a bit more time. Could be days, could be hours, who knows? But there is still, especially because we reclaimed an area which was expected to act as resistance, there is still a chance that we completely fill the gap in here. What else? The Australian dollar, it started the week by going up, and then it came back down. But overall, we spiked. We got back into this previous area, which was resistance. It's been confirmed as support for now, although very sloppy. It's not, clean and dry. But nonetheless, up until the point it holds, it should keep on being bullish on the Australian dollar. All right. So let's have a look at oil. Now, oil started out the week by coming down, right? Monday went up and it came back down on Tuesday and Wednesday. Again, we found resistance in here. On a Thursday and a Friday, we spiked to the upside. I think, it's just a bit more volatile. It looks like maybe we are finally trying to break out for real out of this downwarding channel, or what do you call it? Broadening wedge? I don't remember the exact name of the pattern, but anyway, and it might be what's going on in Venezuela. It might be whatever, but I think most of it is just that things can just keep on going down forever, right? And again, look at this. We had, after testing back into the high side of the channel, we had multiple times, right, to go down, right? So at a point, if it fails to have continuation, probably we'll go into seek liquidity on the other side. And look at that. If you just look at these leg down, right? Every time, right, we tried to push below this low, right in here, look how very little and tiny participation we had, both in here, but then, even in here, right? Not really a lot, although, to see what's going on in here, you should extend these things out at least to here, right? But yeah, it's kind of the same. No participation below here, bounce, and every time we started to try to crack this level back down, not a lot of participation. And at the end of the day, the market just came back in the bulk of the volumes. So could be something like it might be the oil market needs to going around on through another period like we've seen in this one right here, where it was choppy, but it wasn't really going anywhere most of the weeks. It could be. I think I keep on maintaining my kind of mid to long term view that I think oil prices, they will come lower throughout 2026. Probably in the 50s, or I think that we're gonna see 50s in 2026 at some point, right? I'm not telling you tomorrow or next week or next month. I think at some point the fundamentals should suggest that we keep on drifting lower. Could we have some spike in between? Yeah, especially with what we are seeing all across the globe, right? So don't want to talk a lot about Venezuela because again, one, it's too long of a topic. And secondly, it's very polarizing, and we're not here to polarize people. You might say, yeah, well, then just look at the objective data. Sure, it would take maybe 2 hours to discuss everything which is going on. From, the resources available, how the things are going to be supposedly run from here on out, whatever could go wrong in this master plan that they got for Venezuela, who knows, right? Which is why I think if you're just interested in markets, it's a bit of a stretch to going off of Venezuela and starting to consider and to factor in everything there is, right? Which is why I decided to not talk about it. I'm going to say that I was a bit disappointed last week because I woke up. I didn't even turn on the TV. I started recording the video. I finished and I went on the usual chats that I spend the most of my days in. And there were guys posting, links to Twitter or to X, reporting what was going on. And I was like, shit, I completely missed it. I mean, could you tell me a little bit ahead of that before I started recording? But probably again, I wouldn't have included that anyway, right? So that would be it for oil, I think. One thing which it might be a bit more fundamentally driven, it could have impact not only on oil, but if you think about the energy sector, I was reading that it looks like now Venezuela is open for business. Trump actually met a lot of oil producers or driller or miners, however they are called. And just one consideration for me. The first one was, so they are brought into the conversation only after we took out Maduro. So, the master plan of going there, kind of, again, quote unquote, I don't want to project or give the impression that I am, massively in favor, massively against it. I'm just trying to come up with a different potential outcomes. But, among all of these, it was funny because, yeah, we are going to run the country. We are going to take control of the reserves. Yeah, but you didn't talk with the ones which should actually go there and actually drilling. And even more, right? If you're counting on private companies to go there, investing billions, setting up infrastructure, I mean, you should guarantee that the situation will be stable for the foreseeable future. Not only 6 months, but like 2, 3, 5, 10 years. And I mean, I don't know. There is a lot of risk there, right? With oil prices so suppressed, energy companies are already, seeing their revenue stream shrinking. Now you're asking them to commit billions in investments, and they might look at that and say, well, margins are not good enough for now already. Plus, I mean, this guy is going to be out in 3 years. Or maybe, let alone, he loses the House or the Senate in November for midterm, and he's not going to be able to pass any type of legislation. What am I going to do then, right? Again, I think those are considerations that people which have to post real billions in, they tend to do them. It's not like your favorite poster or account, which is going around saying, yeah, this is going to happen because, Orange Man said that. I mean, yeah, he can say a lot of things, as any other president, of course, but doesn't mean they're going to be, a reality in the next 6 months, 1 year, or whatever. And when you have to post a lot of money, I think you don't do lightly. So, in fact, since we're talking about it, let's have a look at this. Just briefly, right? On the news, if you, I just have a few, right? If you look at, let's say this is Exxon, right? So on the news, it went massively up, right? Opened up on Monday, gapping up. Then Monday, Tuesday, it came massively down and then up again. So I think even the market, it's not fully sold yet on this thing. Let's have a look at Chevron, which I think it's the only one which for now has an actual license provided by the US government to actually go there and drilling, maybe. But massive gap up, came all the way back down, and then it bounced. Now, you might say, for both of these two, yeah, but that is just technical pattern, right? Gap fill, gap and go, up we go, is all cool. Maybe. I'm just saying, I wouldn't judge these things lightly, and I think neither the market should, because, the situation could change on a dime here. So just that consideration across all the entire Venezuela/Maduro thing, right? Now, after that, let's move on to Bitcoin. Now, look, Bitcoin actually played out very nicely. We were looking at this level last Saturday. We were approaching it, and we were in the process of trying to breaking out. We were talking about this ascending triangle, which is usually a pattern which resolved itself to the upside. It did, right? But we came back down into the same resistance we were looking at from the past, which, to be fair, played out even in recent times. Again, once again, 95 level, more or less, we tapped into it and we came back down. Now, this is not necessarily bad. I mean, it's bad only if you start seeing these now cracking back below this level, getting back into the previous range. And now we have a lot of liquidity or trading stops, which could be ran out if we so choose, right? But, before being massively worried, let's consider another alternative, or let's zoom out the context, the scenario. Now, it is true that was an ascending triangle, but if you now zoom out and extend this line right here, right? And then you extend this line of resistance, which is confirmed as resistance so far. What do you see now? Starting from here, basically, right? It looks like a much bigger ascending triangle. So that would still suggest some sort of, reaccumulation in here. So we could go like this and then maybe eventually breaking out. I think, if the pattern encyclopedia is right, we are coming into a time where it should break one way or the other, because, these type of patterns, they never get to the extremes, that they tend to break somewhere ahead of that, right? So, could be next week, could be 2 weeks, we'll see. But again, just because we had another rejection, it's not necessarily bad, or it doesn't necessarily mean that we are gonna drop down like a lot. Again, up until the point we can hold key structural level. One of them, of course, will be this one, right? As you've seen in the past, right? Okay. Another important pivot, as we were discussing with other charts that we went through, right? We'll see. It's always a matter of if this and that. For now, I would be cautiously optimistic up until the point, this level hold, and especially we are living above these lows right here. If you want to be a bit more granular, I would say up until the point we do maintain above this level right here, right? We might just briefly breach this one, but we need to hold this one right here, okay? Kind of like this. Not only because it would line up with the diagonal, right, the trend line, but, I do prefer horizontals, and I do think the structure in here, the amount of volumes, the build-up, needs to hold an eventual retest if we want to keep on being, hopeful that this market can actually put its shit together and trying to put together a decent bounce or a decent rally, as the crypto maniac always like, right? So that would be it for Bitcoin. Let's move into metals, and let's start out with gold, which had a very good week. Now, Monday alone was good. Obviously, again, I think even more than oil, I think these reacted to what was going on geopolitically, and they started to price in the geopolitical risk, because, it's like you wake up, or you just close shop on a Friday night, you wake up on a Saturday morning, and you see what's going on in South America, Central America, whatever. So what are you going to say? And then you spend the rest of the weekend watching news, reading posts, listening to podcasts, and, of course, there are different voices. It gets very polarizing. The only thing with it's generating is uncertainty. So what do you do on a Monday? You know what? What's the only thing which can shield me or hedge me from geopolitical risk? It's gold. It's no one liability. So I'm not surprised to see gold actually ramping up straight out of the gate on a Monday morning. On a technical level, if you zoom in on the 4-hour, again, we held this area of support, and we eventually bounced back up. I think last week we were discussing the hourly time frame. So we identified the 4,400 level as resistance, and the 4,300 level, I think, if I'm remembering correctly, as support. So we were still stuck in this range. So even technically, it played out, right? We broke above it, tested back into it, and then we ran. So, not bad. We traded very technically because we had the first level of resistance, which was respected in here. As you can see, it stalled like a little bit. And then, we tapped into the other level of resistance, this point of release right in here, right? And we came back down, finding support where? Well, into the base we just building up before going up. And we went up even more. So, at the end of the day, it traded very technically, and it was a nice up move for gold. Guess again, my first bet would be driven not only by the general trend, the general momentum, but also by the exacerbation, so to speak, of the tensions in between Venezuela and the US, which of course escalated to the level that they just stormed in and captured Maduro, right? The others, so yeah, I mean, pretty much they did kind of the same all across the board. Silver started the week in here, immediately went up, then came back down and held this level of support. Same for platinum. Up, came back down, bounced. Bit more of an anemic bounce. Same as a palladium, which did the same. Went back up, came back down, bounced. Compared to silver, which bounced straight back toward the highs, these two are a bit more subdued. Even copper, to be fair, but it's interesting to see how they all fit the same pattern. Started the week strong on a Monday, right? Completed a full swing, kind of like the DXY if you think about it, on a much smaller time scale, and then bounced, right? So you see why I always say that, the market is fractal, price is fractal. Different patterns, different behaviors can be observed across different asset classes and across different time frames. This is basically that same concept at work for you, right? So, do we want to throw some shit at precious metal this week? I guess we won't, but obviously it's a figure of speech. I'm joking, but just again to keep things in perspective, and again, as it was, I guess 2 or 3 weeks ago, just to prevent those which, like me, are playing with margins and leverage, just to prevent those people to hurt themselves. And again, doesn't really impact those which are holding for the long term or holding physical or are not in any way, shape or form involved in margin trading or using leverage, right? Now, with that out of the way, let's start out with something which could actually impact pretty much everyone involved, right? So this is silver, right? We are reaching into level of deviations from long-term means, which, if you look back in the past, they generated at a point, and again, could be today, could be in a month, could be in 6 months, right? But at a point, mean reversion is the most powerful force in markets. And just look at the past, right? Now, in this chart, what they do is they highlight the deviation away from long-term averages. They show you that, we are seeing really high overbought levels, both on the RSI and the MACD. The MACD has never been so high, to be honest, okay? But I guess this is just the math of the indicator, because we never reached into these levels as for price, so yeah. And they kind of give you an idea from current levels what type of drawdown you could see if we get back to, the second standard deviation, to the long-term average. If we have a full-on rotation back to the other side of the range, let's say if we go from massively overbought or we are trading at a massive premium back to a massive oversold or discount. Now, not to say that the market is going to tank almost 90%, absolutely. But, in the past, you had your 47, 59, 72, 41. So just be aware of that. It doesn't have to happen right away. But again, I'm just thinking that sitting there saying, well, it's never going to happen because it can't happen because the monetary system is broken. Yeah, well, maybe you're right. The monetary system, it is actually broken. And maybe, let's say now we're talking about silver, maybe silver will go to 200, 300, 400. What happens if in the process, it came back down to 40 before, or to 35 or 30, whatever you. If you're just holding it in a safe, or you just buried it under the ground, that doesn't matter for you. If you're holding whatever ETF, especially if it is a leveraged ETF, if you're holding futures, if you're holding options, that's a different story. And you should be mindful at least of the risk, right? Therefore, be mindful that as soon as you see things starting to be cracked out, just the risk. At the very least, the riskier positions. And, technically it played out perfectly because we were looking at this base, right? And what was the assessment last week? Up until it holds, that's fine, right? You don't want to see this. You don't want to see price breaking the base and starting to go down. At that point, get out of the way because it could draw back a bit more, right? And very quickly. Never happened. Actually, we started out and we went up. So all cool. Even you with your margins, you're cool for now, right? Paradoxically, on this run up, people might have added even more margins. So we'll see. Plus, we always have the ghost of the CME potentially increasing margins. So always a risk to keep in mind. Now, why I don't think that this run up in metals is actually a call for the death of the current system, the fiat currency system, the monetary system. Well, first of all, I'm not seeing yields spiking, right? Now, sure, we are looking at the TLT here, but just invert the chart and you would have some sort of a representation of yields, which we are going to look at later on, right? So that's what you would expect in an environment where the currency is dying. I'm not talking just about the dollar. It could be the euro, it could be the yen, all right? It could be whatever currency, right? What else would you see in an environment where all the currencies around the globe, but we keep on talking about the dollar because it's kind of the king of the currencies, the fiat currencies, right? What else would you see? I guess you would see some sort of a hyperinflation, right? Are we seeing it now? No. And even expectations are particularly subdued for now. So, it looks like the markets are not pricing in hyperinflation, therefore no currency oblivion for now, right? So, yeah, the metals, they will keep on going up in prices because they are what? They're assets. And what's the natural pattern over time for asset classes? To go up. Because, yeah, the currency is losing purchasing power over time, right? This is the very reason why people invest, right? But there is a difference in between having a currency which is losing purchasing power over time at a slow enough pace because you actually need inflation to generate economic growth, and a currency which is just hyperinflating like the Weimar Republic or some shit. So, be careful calling for the demise of the fiat currency system. It could be at a point again, but maybe it's not today, right? Plus, just think about it. We are looking at all these charts. How do we measure silver? How do we measure gold? How do we measure Bitcoin? In dollars. So, if you think about the different functions of money, like medium of exchange, the dollar is the actual money, or the euro, or the yen. It's not gold, it's not silver. Because even if you want to spend them, you should swap them for money, actual money, usable in the real economy, and then purchase whatever you want. It's not like you are going to go shopping and paying in gold coin or whatever. So one is an asset, another one is the money, which is, again, not only the medium of exchange, but also what? Measure of account, right? So again, it's a long debate. I'm sure no one will change his mind just because I'm saying these two tiny little things, but it's just a consideration in my view, right? Sure, the dollar lost a bit. If you look at the currency composition of the global reserves, yeah, it lost a bit of terrain, of course. Is it because the dollar is going away and the US are failing, or is because other regions, other areas in the world actually gain traction economically over the last 20, 30 years? Why would you hold Chinese yuan? Well, the same reason why you're holding a lot of US dollars. Because if an economy is particularly strong, if it is a major player, right, you're going to need to have a bit of your reserves stored in that denomination because you will need them in order to conduct business and commercial transactions with that country, right? So, it's not unusual to see, the euro or the They say other, but mainly it should be the Chinese yuan. It could be a little bit of this, a little bit of that, but mainly I think they're referring to the Chinese yuan, right? Which for me, it makes total sense, but it doesn't really doom or sentence the dollar to a sudden, unavoidable death, right? So to speak. Plus, I get the point of currency debasement, sure. But if that's the case, instead of holding gold, for instance, let's use gold as a proxy for precious metal, why are you not holding stocks, right? Over time, right, if you look at this chart. So, and again, over time, corporate bonds return you more than gold. Now, sure, there are periods, as you can see, where, like in this one, for instance, let's see, from the 70s to basically the 80s, where gold is overperforming everything. It's overperforming the stock market, which is relatively stagnant, right? It's overperforming corporate bonds, which are stagnant, while gold is going up. Obviously, it's overperforming every other treasury bond in the US, sure. But then what you have getting into the 80s, end of the 70s, beginning of the 80s, gold underperforming up until 2002, right? More or less. While instead, stock market was going up, corporate bonds going up. When you think about the returns, even US Treasury bonds were performing better than gold since the beginning of the 90s up until, the 2000, mid-2000. It just peaked out in the 2008 crisis, yeah. So, again, you might be right that fiat money are actually debased, but look around. There might be other stuff, other objects, other assets, which over time are maintaining your purchasing power even more than gold. Now, you might say, okay, but that is true, but it is also true that, let's say, I also need to mitigate the risk of, I know nobody's expecting it, but let's say I'm investing a lot in US denominated asset. And what if one day my country, which for me is Italy, for you could be China, it could be whatever. What if one day my country gets into, some sort of a very difficult relationship with the US and they decided to seize all our assets like they did with the Russians? So I'm also trying to mitigate that risk. And in that case, I would agree with you, right? If there are other reasons beyond the simple math of the returns over time, then fine. And quite honestly, I basically owe nothing when it comes down to the stock market. I just started recently in 2019. The majority of what I got is gold. So again, you see, I make a choice, but I'm very aware of the other implications. Plus, the stock market, I tend to trade it a bit more as for indices, while gold is more of an insurance policy for me. So again, there are many different implications and things that you could factor in. But, the argument that, I prefer gold because I want an inflation edge. Yeah, sure, there are better than these, right? There are others which are better tools if that's your solely goal, right? Just to clear out the air. And finally, as we discussed, for the CME, margin requirements being increased and whatnot, it started on Thursday and it's probably going on for the rest of next week. This one right here. Now, again, I just read what's going to happen. Basically, they're going to see a rebalance because of the commodity index. And of course, it's like a normal portfolio rebalance. What's going to happen? Well, if you need to match a specific allocation, and then some of the assets that you hold are going massively out of weight because, they're massively going up in price or whatever, how do you rebalance them? You trim them. How do you trim them? You sell them back to target weight. And it looks like there could be the potential that this rebalance, which is occurring or could occur, might bring in a bit of selling pressure, especially on stuff like gold and silver and all the metals, right? And, if you had enough time to read the paragraph, you got the chart below if you want a bit more details. But roughly speaking, this is it, right? This is what the rebalancing should lead to, and which could, very important, could be the asset which are going to be impacted more. So if it is negative, of course, it means that we would need to see selling, right? If it is positive, it means that in order to balance things out, we should see buying or purchasing, right? So, crude oil, nat gas are at the lower part of the chart, so they could see some love. Silver, aluminum, gold, they are in the higher part of the chart, so maybe, just maybe, these together with the margins, which are a bit higher now, they could be some hate, so to speak. All of these to say, be mindful of the potential volatility, right, coming into next week. And again, not saying all of these is going to crash, but, we might have another few days like we have seen, like, I don't know, previous Monday or previous Wednesday, something like that, right? So again, to close it in, if you're playing with margin, just be aware, right? Otherwise, fuck it, you don't care. If you're holding physical, let's pretend I didn't say shit for the last 10 minutes, right? Now, yields, what about yields? We were looking at a steepening last week, and it looks like this week it was instead a flattening, because we have seen the 2 years coming up, the medium end of the curve staying relatively flat, and the long end of the curve coming down, so probably flattening. At this point, I don't really think there is a lot to discuss about yields. Most of what they will move on, I think, is going to be, the more clarity we start to have on which one will be the next Fed chair, and I think that's going to be what moves yield the most over the coming weeks and months. There is the entire debate about Fed credibility, because Hassett, it could be a detriment to the Fed credibility because he just wants to lower rates, go on with QE. It's a very grow and only growth oriented process. While instead Warsh seems to be a bit more responsible. He doesn't really believe in QE. So, I think the bond market will move a lot depending on which one will seem to be, the final nominee for that chair. Other than that, not a lot of movement, really. And even if you look at the futures, they stayed, like the 10 years opened up in here and it closed at the same level. The long bond opened up where? In here. Sure, it went up a bit more because the yields on the long end came down. And, the 2 years, it came down a lot. I mean, relatively speaking, because, of course, 2-year yield went up a bit more. So, yeah, still reflecting a bit of a flattening this week. But in the grand scheme of things, I mean, can you really say something drastically changed? I don't know. I don't think so. Just look at that dynamic with the Fed nominee and keep on monitoring what's coming out from the economic calendar as for growth projection, labor market, GDP, and all the rest. Because at the end of the day, yields, and therefore the price of the underlying bonds, will be over time just a reflection of future inflation expectations and economic growth. That would be it, right? So after that, little bit of a brief pause so I can try to recover my voice, which, it's not the best. And we will get back to it, ending up with the stock market as usual. So what went on as for the stock market? Let's have a look. Now, the S&P was up 1.60%, at least, again, if you look at the ETF. Major drivers, consumer discretionary materials, Not surprising considering how, metals and metals miners are actually performing. Industrials, and we will look at how for the vast majority of the week, but, I should say lately, overall, the Dow overperformed other sectors like, technological sector, energy, because of course the rumors of Venezuela being open for business to US, American producers, they immediately jumped up. And what? Consumer staples, 2%, financials, 1.5, and technology. Yeah, I mean, it was positive, but, compared to the rest, it wasn't the leading one. Healthcare, a bit subdued, still positive and in the green, but, bear in mind, if you think about, the sector as a whole, it had a very good run. So, at a point, we get back into the same talks about rotation. Communication services, below 1%. Real estate, not so cool. Utilities, well, they were down. So this is some sort of a high ground view. And for the sake of it, let's have a look at the heat map so that you might have a much better comprehensive view. And then let's have a look at the charts. Now, as you can see, starting out on Monday, the market from the weekly open, which is here for the NQ and basically here for yes, immediately started to go up. It was interesting, the point, as I said, from where it started to go up, because if you look at, for instance, NQ futures, they were here, right? ES was here. The Dow was here, right, when it opened up. So it was immediately above the nearest major swing high, which, it would be in here. For NQ would have been in here, and for yes would have been in here. As you can see, throughout Monday alone, the Dow kept on rallying, like, massively in here. ES, they managed to get above that swing high we were discussing. And Qs, no, they didn't. They tested back into the apex right in here, and they pulled back. And it took another day getting into Tuesday to actually manage to target this high right here. So that would be the first thing, which immediately out of the gate, it tells you that you might look at a week where NQ is going to lag the others, right? Now, after that, we had a Wednesday, which was down throughout the overnight session, up in the US session, and then, immediately reversed back down. And again, this was another point where, they all basically pulled back, and, it was a very pronounced pullback. But as you can see, throughout, then Friday, they kept on rallying higher. And, the Dow closed the week relatively near the recent highs, same for NQs. And yes, they actually broke above it. So I would expect, new all-time highs. And, they just closed around the previous highs. But, when you close at a high enough level and you don't give back a lot, that should be positive, all things considered, right? Now, when you zoom out, I mean, it's immediately clear which one is lagging and which one is leading. So the S&P, it's relatively good. The Dow is actually performing very well, but even the Russell, look at the Russell over the last, 5, 6, 7 sessions, right? Look at that, straight up, right? And NQ, it's kind of falling behind a little bit. Now, again, we have been talked about rotations. We have been talked about high beta stocks, mega cap in the tech sector stocks, and all the rest, right? It is just the way it is. Sometimes you have these different sectors taking turns in which who's leading and which one is actually lagging. It looks like for now we are living through a period where the tech sector is lagging a little bit. Is it a massive problem overall? Well, I don't think it necessarily is, up until the point you start to enlarge your horizon when you assess these things, and you make it wide enough, because, you need to think about which are the companies which are the responsible for the majority of APS growth, for instance. Well, the Mag 7. And a lot of the Mag 7 are basically included in the tech sector. So, over time, if you want to keep on seeing the market going up, you will need the sector right here to show a little bit of strength, right? So far, as you can see, yeah, the market is going up, especially the S&P, right? But, you know, it goes up a bit, it retraces a lot, and it goes up a bit, but it looks very choppy. It's not your, you know, super powerful rally like we were looking at in here, for instance. Basically, starting Q4, I think, you know, things change around a bit, right? But, you know, at the end of the day, up until the point the market goes up, the structure is still good. I don't see any major issue with it for now. Although, you know, we are just at the beginning of the year, and we discussed across the end of 2025 and last weekly video, which one could be, you know, a risk for the year which is to come, or, well, should I say, just started. So let's have a look at the ETFs. There's not a lot, even this week, right, to be said about the markets technically, in my view. If you look at the moving averages, we almost had a pinch of the blue onto the yellow, but never materialized, right? And we kept on using the, you want to call it a moving average ribbon, whatever, the moving average set, right, as support, and it looks like we still want to rally. SPY, it's kind of the same, but better, right? So the only risk I would see for this one, like if you take a look at the QQQs, like you see this area right here, right? We have been approaching these a few times in the past, right in here, and every single time was a rejection, right? It was a rejection in here, here, then here, here. So I think one of the risks, let me just try to change the color. I just want to draw something real quick. So one of the risks that we might see next week, and I'm talking about risks, I'm not talking about absolute realities, but what you would expect, it would be to break out of this area right in here, right? And then, you know, keep on drifting higher. Now, it might be, you know, a straight moonshot to the highs, or we keep on being choppy. We retest this area around one more time. We hold it and we keep on drifting higher, right? And that would be the bullish resolution in my view. What you don't want to see, in my view, it's, you know, a bridge relatively quick above it and immediately falling back into the range. Because if it is true that we have some sort of a balance in here, right? If we go out of balance, so we try to establish, to auction price to a new area, and we immediately fail, it's very likely that not only we're going to get back into the previous range, but we might target the other side of the balance, which should be kind of like around this region right here, right? So again, if you want to see immediate bullishness or continuation higher, you don't want to see, you know, how do they call it? Look above and fail, something like it, right? Or, you know, a failure or at a previous high, whatever. Definitions at a point, as long as you can understand the concept, doesn't matter how you call it, right? Momentum looks to be up for now, although, you know, at a neutral level, more or less, it's not extreme, so that would leave the door open for a bit more upside. Same on the MACD, although we have been seeing it flip-flopping a lot. I don't know at this point how much weight. I might look at the histogram even more to see if we have a high, right, printed compared to the most recent one, right? But, you know, there are no divergences present on the RSI in the very short term. You know, the long term is a completely different talk because, you know, if you, especially, you know, if you look at SPY, right? Yeah, we kept on printing new highs, but the RSI is going down. So I think that just leaves the market vulnerable to some sort of an exogenous event. So we are already seeing divergences, relative strength, it's coming down while price is going up. You know, if you have some sort of a news event, geopolitical event, whatever, that would be a good enough catalyst for a market which is not showing massive strength to maybe pulling back a bit more decisively, which is again why I said I would expect this year to be kind of like last year, probably a bit more volatile. Doesn't mean it's going to be negative, but just for the sake of being prepared. Other than that, even if we try to zoom in on this one, what we could expect, I think again I would be bullish oriented for the next week overall. But just remember, it's not unusual to see huge pullbacks throughout the week. So just be ready to navigate potential volatility ahead even more, right? But, at the end of the day, if you zoom out, the markets are going up. Now, after that, I think, there's not a lot to discuss technically. If anything, we never discussed that, but, when we talk about this look above and fail, right? And getting back to the fractal nature of a price, I might show you this. It just inverted. So let's say if you invert this chart, right? And you look at this level right here, right? You see how many times they are trying to push it up. And so the concept, if you invert the chart, would be, well, if they can't actually breach it, right? At a point, it's going to, it will need to trade back higher in this case because the chart is inverted, okay? Now, I wanted to show it inverted because it would line up and would match up better with what you see intraday. Now, this is an actual trade I took, and it was Friday. It's kind of the same logic, right? Now, beyond all the different labels you can see on the screen, just forget about them for a minute. Let's just focus on the structure and potentially on the indicator on the bottom side of the screen, right? So you see the market, it's going up, it's making a high, then it's pulling back. And what you see, this area right here, which, for reference, we were basically looking at this level right here. That was the area, so to speak. That was the time period. It might be better to be visualized on a time-based chart instead of on a tick chart. So this is your New York Open for Friday. The market was choppy, it started to go up, and it pulled back, right? And it pulled back right where? Well, basically here. Right? So you could deem it as resistance, breakout, retest, right? Okay. So why it is important? You see the market goes down. There is a decent amount of selling in here, considering the time scale we're looking at. And then, it came back up. It goes back again. There's not the huge amount of selling we were looking at before, and it comes back up. It goes back down again with a huge, but with a much bigger compared to this one amount of selling. And again, it fails for the third time. And then what you see buyers stepping in. Now, it's kind of the same concept I was trying to describe. It's that, they're trying to push it lower, right? They are trying to push it back down below that previous resistance, right? And they are failing. So what happens if they fail? Well, the market is going to keep on going in the other direction because they failed at auctioning it back down to a previous level of balance, which again would be this one, right? There was this type of a balance. Initially, we tried to go lower. Once again, you see there is a balance in here, right? You try to push it lower, and it means reverse straight back up, and up it goes. Now you have this old balance. We try to push it back into the previous balance area right in here. We failed, so we need to auction price to a much higher level and to create what? A new balance, although, as temporary as it might be, right? So this is the same concept which could be applied intraday, because if you just look at the time, right? That was happening in a span of what? 15 minutes, more or less. So, it's kind of the same concept that I was trying to describe on the NQ chart. It's just inverted. And it offers up the opportunity to, getting back to the NQ chart, right? You see it, poking above it and immediately getting back below it. Kind of like it did in here, right? To edge yourself. I'm not saying you should go naked short, but maybe, up until the point vol, it's low enough. I'm just wondering how much would cost you to buy some weekly expiration puts, just to hedge yourself. Doesn't mean the market is going to crash 10%, but, just for the sake of it, in these times of volatility and uncertainty, that could be one. So, yeah, I mean, just to show that things that can happen on a larger time frame, they tend to happen on a smaller time frame. Ending up this trade review, well, I usually tend to close, I just want the move to rebalance itself. I tend to close at the first available area where I think, there were volumes before, as you can see from the structure, right? This range goes down, creates another range, goes down. So I'm going to close at the first available area, which I deem as a first trouble area, which, by the way, would be an area where you would expect a bit of resistance, right? Which, at the end of the day, just for the sake of completeness, we kind of had it, right? You see, it pulled back a little bit, and then it kept on going higher. And then the rest of the day was just me basically not getting what I wanted. But I tried to short in here, didn't hold the retest, and then it actually came back down for the, to retest the previous breakout area, but I was out already. Then I longed, but I closed at break even that too, because it wasn't really going anywhere. I got stuck in basically in this range right here, but it wasn't really going anywhere. So yeah, I ended up the week there. But just to show you that what may happen here, it's just what you just see on an inverted chart, much more smaller time frame. But this is how price generally tends to move, right? Or at least this is how price moves or offers you up the opportunity to create different scenarios. And when you see that one, it's not materializing itself, it might be that, the opposite one is unfolding. So those are market generated information, and you have the time and the way to act upon it, right? So after that, what about the stock market, generally speaking, as we usually do to end up the video? Now, for this year, I think, as I said, earnings might be a risk, especially the failure or the disappointments in earnings. Now, this is just to show that the estimates for Q4 earnings for 2025 over time, right? Which means for Q4 2025 at the beginning of the year, January, this was the projected earnings, and then we went up, then massively down. So you see how even the forecast can change. Now, why is this a problem? Well, obviously because it could impact how the different stocks are priced in, right? The problem now is that expectations for next year, so 2026, are particularly higher. And what happens when they are particularly higher? They are easier to be disappointed. Again, it might be whatever, we don't know, but just pay attention and try to think how the market would think. Whatever could impact these projections and, bringing it or revising it lower, that will impact as well how the price of the stocks, the underlying stocks are going, to be modified, right? So, I think that could be one of the main vulnerabilities. It doesn't have to happen because you don't know what will be the trigger to revise, estimates lower. But, if you think about the price to earnings ratio, right, it's kind of the same. If you revise the E part of the ratio down, well, the P will follow soon enough. So this might be one of the risks for this year. Not the only one, of course. And again, just to reiterate the fact that, all the other risks, just the simple fact we are talking about them, should lead you to believe that if we are talking about them, the market knows them, and market participants would be hedged for those, hypothetical scenarios, right? So therefore, if you expect the market to crash, probably those reasons we were going off last week probably won't be one of those. Right? It would be something unexpected, right? Something the market didn't price in. All the rest, by the simple fact you can make an hypothesis for it, should be baked in the cake, right? Other than that, look, just, if you look at the year ahead, this is basically how the market closes. If you look at these yellow squares, right? But these are the highs and the lows throughout the year. So as you can see, it's easy to say that, well, yeah, I'm expecting the market to close here or there. Could be 7,000, 7,200, 7,800. Yeah, sure, maybe. But, can you navigate that volatility? Take this year, right? The market closed particularly high, but we went down almost 20% in, before it was all said and done. So just when you're talking about risks and when you're talking about forecasts, it's not just about the final destination, but it is about how you manage that and how you manage to walk the path toward it, right? So should never ever discard that. Then what? Oh, well, I mean, tiny little stat about a year of consecutive positive returns, and as you can see, 3 years, it's a good line in the sand. Doesn't mean that we cannot have 4 or 5 years of positive returns, but they start to be more about outliers rather than the rule. So again, could this be? This is finally be the year where we have lower than expected returns. I'm not necessarily saying negative, but maybe lower than expected. So who knows? It's just another thing to consider. And now we get back into the different talks about the stats, the seasonality, and all the rest, right? Now, well, before that, just again, the breadth, it's improving a little bit. You see the RSP going up, while the index, the market cap weighted index, it's struggling a little bit. See, it's drifting higher, but it's not going up as much as the RSP is going. So a little bit of a broadening market, which, for the long term should be good, but in the short term, it just means we are losing a bit of momentum, all right? But, getting back to those seasonalities. Look, the Santa rally basically failed this year. So these are just a few iterations where the Santa rally failed and the returns for January, for Q1, and for the calendar year as a whole. Now, as you can see, it's not necessarily a death sentence for the calendar year or not even for Q1, right? But, overall, for the month of January, it's not a good sign. And although I'm maintaining a good enough bullish stance for now, it is also true that we just had one full trading week for the month of January. So anything could happen, right? And these are just stats that, again, you just need to take and to keep in the back of your mind. But there is more. If you keep on going, this is basically what happens, right? When, the Santa rally is positive, right? Negative, right? So just to take the example, since we are looking at a situation where the Santa rally didn't materialize itself, right? As you can see, overall, it doesn't necessarily mean that the market will return you, negative values. It just means that a negative Santa Claus rally, well, at least it impairs huge bang-busters returns, right? So to speak. It's another thing that you should consider, right? Now, there is, again, the stats for the first 5 days of the year, which, for now, even if you look at the chart, right, it looks good enough, right? So, well, if you then take into account all the stats, you should keep on maintaining a positive enough stance, in my view, right? Because, the first 5 days, they closed relatively good. I mean, let me zoom out on a weekly time frame, right? So, well, I mean, the year started when, what was the first day of the year? So this one. So 1, 2, 3, 4, 5. We closed positive at the end of the day, right? I was just double checking because I wasn't sure. So at least, we are supported by these stats. And there is the old Wall Street axiom, like, so goes the Santa rally, so goes the first 5 days of the year, so goes the month of January. It's kind of like the trifecta. If all of three are positive, you should expect very good returns for the calendar year in the stock market. I don't know how much weight we want to put on that, but, if it exists, well, there must be a reason. It's kind of the same as what you see when you look at the best performance month by month on a monthly base for the year, and people say sell in May and go away. Well, yeah, that's basically because then you go August, September, maybe October, a tiny bit, which are the worst performing months. So if you sell in May, you sell basically after the March, April, right? Those months which are particularly good. You sell in May, you buy back at the end of October before the festivities, and the market usually is good going into the end of the year. So all these axioms and adages, they come up out of numbers. They're not thrown out like they were just horse shit, right? Do they always materialize themselves? No, absolutely not. But I mean, they're there for a reason, right? Then what you got, another stat on January. It looks like it's one of the strongest months of the year, even though, again, the Santa rally failed. So you need to square out these two stats, one for January overall and one for what happens in January, though, when the Santa rally fails. So again, the truth is probably in the middle. Like, yeah, it could be something like this. I'm not saying this is how I expect it to play out, but it could be something like this. Yeah, historically, as you can see, January is good enough. All right. 62% of the times it's positive for an average return of what? 1.21%. Sure. Could this be that among those times, so the remaining 38% of the times where it wasn't positive, right? Could this be that those are the times which coincided with years where the Santa rally failed to materialize? So this is how you need to. It's like a puzzle, right? You need to match out different type of stats altogether. It's not always easy. I'm gonna give you that, but it's just more factors to be considered, right, before formulating or establishing your own bias, right? So at least you can do it with a much broader set of information. What else? Let's try to go quick. Now, again, as for the seasonality, this is also a midterm election year. And these are the stats for the midterm year. But again, the good thing about it is that the year is actually particularly subdued as for returns only when it is a new president. If it is a second term, well, we should be good enough, right? So who knows? At the end of the day, it could be that maybe it's going to be another good enough year, like 10% plus return. For the calendar year, totally possible. And then, just to get a little bit into what could be a few risks for this year, right? You've seen, I think this is Blackstone, yeah. You've seen how Blackstone dumped after what? Well, after that, Trump announced that he was to ban institutional purchases of single-family homes. Well, I mean, houses, homes. You get the gist of it. Now, beyond the fact that you think this is good, that you think this is bad, just set it aside for a minute. We're not here to discuss good or bad, moral or immoral, ethic or unethic, whatever. But it is just to show, and I got a bit more examples here, that we are moving into a period where a lot of things will be looking like manipulation, right? But in the context of the times we are living through, I think, and I mentioned it, the man, many, many times, I think thinking about what's going to happen in terms of economic statecraft, as Michael Avery always says, it's a very good framework to have. What do I mean by that? Actually, what he means by that is that a lot of things, a lot of winners and losers, a lot of policies, they will be decided not only based on the fact that they could actually improve one economic sector or the other, but under the perspective and framework of what GDP is for. Yeah, I mean, GDP is going to be 3%. Great. So what? Inside that 3%, what did really grew or what did really fall, right? So it won't be unusual to see things massively favored by the administration, by the government, by whoever, and other things being capped for other reasons beyond simple finance and economic results, right? So bear it in mind. Now, in this case, it could be, well, I need to solve the problem of house affordability. So let's remove these evil speculators from the market because they're just bidding the price up. Is it going to work? Maybe, or maybe not. Or, you might think it worked, but you're not really weighting out all the different side effects. Nonetheless, if you are engaging with these markets, just be aware that we're getting back to that period where we need to watch. Well, back in the days, it was Twitter. Now, I guess it is Truth Social. But one man is talking, and all of a sudden, he could move the market. Or back in the days in cryptocurrencies, where Elon Musk was updating his bio, placing an emoji of a dog, and Doge was pumping 80, 90% in a day, right? So I wouldn't be surprised to see more of these coming this year. Well, this one as well, right? How do you think this will impact the financial sector as for the component of the index, right? You might say, well, but this is more central planning. This is more central control. Some might say this is also socialist. I don't know. I don't care what you think it is. I'm just inviting you to think about the consequences, right? And their possible ramifications. So this is just a second example of what could happen. Because, of course, if you cap the ability of these companies to move the rates, well, are you impacting their margins? Therefore, are you impacting the stock prices, right? Then what else? This one, again, banning or at least preventing U.S. defense companies, contractors, and therefore their stocks to perform stock buybacks and dividends if they, if they don't actually deliver in what should be, the actual build-up or construction of what they are supposed to build up and construct. So it's like the time is over. I'm paraphrasing, of course, and this is not necessarily my thought. I'm just trying to impersonate what the logic could be, right? The time is over for the military complex to just enrich those which are sucking up the resources financially of the country, right? And they're not delivering on what they should actually deliver, which could be make me a new fighter jet, make me a new aircraft carrier, whatever, right? And so in order to stimulate them to actually perform the simple task they have, I'm going to prevent them to pay dividends and buy back their own stocks up until the point they don't deliver on what they should deliver. So again, normally this is going to impact the stock prices, but it also shows you that it's another form of limitation, capping, manipulation, you might say, but it is goal and oriented. And this is what economic statecraft actually means at the end of the day, right? But you might say, on the other hand, if it is true that I'm using this, call it draconian measure to actually, spark you to do better, on the other side, I'm also giving you a lot of money to do what I think you should do. So, you see, it's a double-edged sword. On one hand, I'm giving you the stick, but on this other hand, I'm giving you the carrot, which is what? 1.5 trillion. So again, I think we're going to look at more of these throughout the Trump mandate. And I think it's not just about Trump. It's just how about the world. It's changing and it's moving, and potentially it's reshaping itself. And to think that everything could happen in the world and financial markets wouldn't be affected or even used, weaponized, whatever. It's just naive to me. So just pay attention to these matters, as he always ends up all of his tweets, right? And lastly, I mean, if you need an oracle, just stop going on fucking Polymarket or the other ones. Or just look at what he's posting. And it was fucking hilarious. Look, again, this is not me saying that was fair. Same as when he posted about, it's not a bad day to buy the Dow Jones. And then he announced the, step back of tariffs, and the Dow Jones rallied like a crazy. All the stock market rallied like 10% in a day. Now, I'm not saying this is fair. I'm not saying I'm in favor or not in favor. I'm just saying be prepared to more things like these to happen, because this is where we are moving toward, and it's not going to change anytime soon, I do believe. So just be prepared to live in this sort of environment from here on out. Again, it's not necessarily the Orangeron fault. It's just the world as it is, right? Look, I think whoever would have been there, in some measure or to some extent or the other, we would have seen things changing in this direction, all right? So, it's not to be biased. I just think sometimes the world goes as it goes, and you just need to acknowledge that. So, again, after that, and before I completely lose my voice, this was it. I guess very long video this week as well, but the economy calendar took out a good chunk of it. And again, a lot is happening. And again, we didn't even talk about Venezuela, because otherwise we would have been here for 3 hours maybe. So yeah, at the end of the day, this is it. Just be prepared for anything more than ever now, and be nimble as usual. I hope you are going to have a very good weekend and a very good Sunday. Relax, because we're going to trigger off another crazy week, most likely on Monday. And up until that time, as usual, be nice and be cool. Neil's out.
Mm-hmm. Mm-hmm. Mm-hmm.